pick a number somewhere between $3,500 and 34,000, because we can round and because this chart is a month old or so. And I believe that $200 per ounce figure is a very attainable figure in a rush, and there is a rush that's coming.
Can central banks orchestrate a collapse? They could theoretically. It's possible. I'm saying if a light went off in Jay Powell's head and he says, you know what, this inflationary system, it's going to destroy everyone. I got to end it now. And what I'm going to do is I'm just going to stop printing money. I'm going to sell all the bonds that are on my balance sheet, and I'm going to crash the bond market, and all the banks are going to collapse. And then, but then what would happen to him? He would get lynched.
Gold's trajectory today is being shaped by forces both visible and hidden. The distortion of inflation data, the manipulation of official statistics, and the relentless expansion of currency supply have created conditions that echo past crises, only on a much larger scale. Negative real interest rates, regardless of whether measured by official CPI or alternative methods, continue to erode trust in the monetary system. History shows us that when real rates plunge, gold enters powerful bull markets. With central banks now positioned for deeper and deeper rate cuts, the setup could hardly be more favorable for precious metals. MikeMaloney, renowned monetary historian and author of Guide to Investing in Gold and Silver, and Rafi Farber, a respected analyst and commentator on global financial markets, break down these dynamics with clarity. They point to how official inflation measures like the CPI or CPI obscure the lived reality of rising costs. By contrast, older measures or blended adjustments reveal just how negative real rates are and why gold's surge has only just begun. The fact that 98% of traders expect rate cuts with no bets on hikes or even unchanged policy underscores how one-sided expectations have become. This is the kind of setup where gold transforms from a defensive asset into one with outsized gains in purchasing power. Against a backdrop of manipulated statistics, negative rates, and global uncertainty, precious metals are emerging as the ultimate haven. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
This is a great return, but the return they're talking about, that this does introduce risk. And so they're talking about something that introduces a counterparty risk on your physical gold. And I see no reason for it when you've got this type of spectacular return. There's nothing else that has done this in that time period. This is huge. And to be able to, I said in my first book, and I think I said it in my second book, that there are these rare moments in history where gold becomes not only the safe haven asset where it's insurance, but it also becomes the asset class with the single greatest gains in potential purchasing power. And we are in one of those right now, and this proves it. I thank you, David Bateman, because you've proven my first book, which I wrote from 2004 to 2007, you've proven me right. To me, you got to pick a number between these two sets of government numbers. This is not something John Williams of Shadow Stats Government Statistics came up with on his own. It's not lunatic conspiracy theory stuff. It's the old way the government used to calculate inflation, and their new manipulated way where they change every couple of years, they change something on the way that they calculate the CPI. And basically, it saves them a lot by screwing people out of Social Security entitlements and things like that. Anything that where the government is sending out a check that it gets inflation adjusted, the old CPI would cost the government a fortune. The new CPI, it costs the recipient a fortune. And so pick a number somewhere between $3,500 and 34,000, because we can round and because this chart is a month old or so. And I believe that $200 per ounce figure is a very attainable figure in a rush, and there is a rush that's coming.
judging by inflation, the bull market is not over. And in a previous video, we actually speculated that the bull market would continue because of real interest rates, specifically negative real interest rates. And we talked about this chart here, Mike, where we showed that the two bull markets in gold, which are in red boxes, they correspond with the stalactites here, which are negative real interest rates. So basically that's the Fed funds rate minus the CPI.
Yeah. I made some special requests from you.
Yes, you said, well, what if we adjusted this not by the CPI, but by the shadow stats CPI, which is probably more accurate. It's the government's old numbers. And so I did that. And that's basically the black line here. And you can see how deeply negative, like really, really deeply negative real interest rates are for decades.
Wow.
And the gray line here is the midpoint of the two. So it's halfway between the CPI and the shadow stat CPI. So halfway. So,
you know, I think it sort of makes sense too. When you think about the inflation that was happening once COVID lifted and all that currency from the stimulus checks that went out came out of hiding, that inflation that was there and people's real experience. How much more does it cost to go out to dinner? How much more does it cost to go shopping at the supermarket and so on? I sort of believe that gray line in the middle. Because the real interest rate that's in red, the real rate adjusted by the CPI, doesn't fit my experience in real life.
Yeah.
So,
yeah.
Okay.
I think the gray line probably somewhere in the middle, but either way, we've got negative rates, negative real rates, no matter which metric you want to use. And I want to look at
before you move on though, do you see how the gray line in the 90s is hovering around 0? And then where the red box starts is where the gray line dips significantly below 0, right where the red box, that gray line corresponds to the bull market in gold perfectly. And one of the things that we, analyzing so that we could define this for everybody, because I hate tables. I love charts. I hate tables. But there's a column missing, a column of, will they leave everything alone? All the way to the right, if there was another column there, that's if they're not going to do a rate cut. So 98% of the market is betting that there's a rate cut. And from then on, the rate cuts get deeper and deeper and deeper. Perhaps I'm pointing the wrong direction for the video. I don't know. But when you get down to next year, nobody is betting that they're going to cut like a quarter point or something. Everybody is betting on some pretty deep rate cuts coming up. So there's no bets going up. Every bet is going down. And wow, there's 250 to 275 basis points so that's 2.5%, right? To 2.75% is still at 19% of the survey is betting that they're going that low, 28% roughly, 2.75 to 3. And what's the current rate right now?
Right up here between 4.25 and 4.5, but they're probably going to cut it tomorrow.
Okay.
So yes, to your point, Mike, there should be a column. Ordinarily, there would be a column here, which is, people are betting that the Fed will leave rates unchanged. But that column's not there because there's not a single trader that's betting that rates will stay the same. And there's nobody that's betting that rates will go up at all in the next 15 months. So everyone's betting it's going to go down. It's just a question of how quickly does it go down? How far does it go down? This is so bullish for gold and silver.
In one of our last videos, you also presented a chart that I can't remember. I think it was from Tavi Costa. No, it wasn't Tavi Costa. But it showed that every time they do rate cuts, when there's a rate cut cycle, it's rocket fuel for gold. Gold just takes off. So, and gold is already taking off, and we haven't even started the cycle yet.
Exactly.
Okay.
Central banks find themselves trapped in the very system they built. Theoretically, they could end it by halting money printing and liquidating their balance sheets, but such a move would instantly collapse the bond market and banking system, and those in charge would be blamed. Bank runs, mass panic, and financial collapse. The consequence of this cycle is stagflation, where inflation persists even as growth stalls. Similar conditions appeared in the late 1970s, but today the situation is amplified by far greater debt levels, social unrest, and geopolitical risks. Unlike 1980, when only a fraction of the global population had access to bullion, today nearly the entire world can participate. With 18 times more potential buyers, 55 times more currency in circulation, and only twice the available gold, the imbalance points to an explosive outcome. Let's get back to the interview.
I'm not a central planner, so I have no system. I don't believe in any system that will be organized by anyone like me, or because I don't know what to do.
Right.
All I know is that the free market can organize it by itself, and all I would be responsible for is enforcing property rights. That's all that governments can do. That's all they should do.
Right.
And that's all they would do in a society that is just. So, I mean, your question, can central banks orchestrate a collapse? They could theoretically. It's possible. I'm saying if a light went off in Jay Powell's head and he says, you know what, this inflationary system, it's going to destroy everyone. I got to end it now. And what I'm going to do is I'm just going to stop printing money. I'm gonna sell all the bonds that are on my balance sheet, and I'm going to crash the bond market, and all the banks are going to collapse. And then, but then what would happen to him? He would get lynched. So he's even if he wanted to do that, he's trapped. Even if Ron Paul were head of the Fed, he would be trapped too, because what would he say? He would say, okay, so people, I'm going to collapse the system now. Everybody hunker down. And then there'd be a bank run the next day. All the banks would collapse anyway. He wouldn't have to do anything. It would just by him saying that, it would be over.
Absolutely.
And then he'd be blamed. So the central bankers are caught in the same system that we are. They can't end it, even though theoretically they would have the power to. If they even tried, they'd be lynched and they'd be dead. So they got to keep it going for as long as they can, until they have maybe they're smart enough to have an exit plan and they can go to an island somewhere, or they will actually be lynched in the street. I'm not advocating that. I hope that doesn't happen. I hope they just run away and go into a bunker and never come back again. I don't want to see any more violence, but they are as trapped as we are, and they're as hopeless as anybody else, even the poorest. I think we're weeks away from something big happening in the plumbing, and I don't think that's going to lead to hyperinflation immediately, but it will restart the printing. And once it does, we're already on the cusp of cutting rates into an inflationary cycle, which it should kick off stagflation, and that should really accelerate us into the end of this. I don't think we have much time left. And the less time we have, the better, because then we can get all this violence over with, and hopefully there's hyperinflation tomorrow and there's no more time for any more violence. But no, there's going to be more time, and it's going to be tough, and we just have to support each other and realize that it will be better on the other side, and humanity's not ending. We can't have those doom and gloom thoughts, because we are the hope for humanity.
Right.
We are. That's our position, because we understand what money is and what money isn't. And money makes the world go around, not credit. Credit doesn't make the world go around. Money makes the world go around, because credit is based on money. And that's how it is. And either we take charge, or the world stops going around. And the world's not going to stop going around. We're going to take charge. It just depends how quick we do it and how quick we are on our feet. And that means just keep stacking. And then when everything falls, buy everything you can and support your community.
Is it too late to get into gold? Why or why not? And David Ingalls here says gold prices have topped the inflation-adjusted price set 45 years ago. So is it over, or is the bull run going to continue?
Depends on what inflation indicator you subscribe to. And it also depends on, you've got to take a look at what was happening in 1980. There were a lot of similarities geopolitically, with wars and with, there tremendous amount of similarities, except debt to GDP back in 1980 was at about 30%, not 120 or whatever it is now. I can't remember the exact figure right now. right now we seem to be in some social unrest where the country seems to be falling apart. And then on top of that, we've got the potential of World War III, like always, just right around the corner. And then you take a look at the book we wrote, Great Gold and Silver Rush of the 21st Century. Back in 1980, it was 10% of the world's population that took the price of gold from $35 up to $873 intraday. And because at first it was just Western Europe and Canada. And then first day of 1975, the US got to join the party. First day of 76, Australia got to join the party. But it was illegal for most of the world's population. There were no markets where they could buy gold, no exchanges that affected the global price. So even if you lived in a place where it was legal, but everybody was poor, South America, Africa, those places, there's no exchanges. So you might be able to buy gold from another individual. In the USSR, all of those Eastern Bloc countries and Russia, it was illegal. It was illegal in China under Mao. It was illegal to invest in bullion. There, you could buy jewelry and coins in India, but there was restrictions on bullion back then. And so the most of the world was restricted from participating. And today it is only North Korea. And that means that, we did a study and we adjusted it for the population growth and everything else. And there are 18 times more people to buy that can legally buy and afford gold and silver. And on top of that, there is 55 times more currency, and there's only twice as much gold available. So, what does this add up to? Even if you, get rid of the 18 times more people, 55 times more currency, twice as much gold, that means there's 25 times the purchasing power coming at it this time. And we've probably got a far bigger crisis heading towards us because of all the energy that has built up from this phony baloney monetary system we've got that is immoral and should be illegal. It's an amazing chart, but the commentary from Zero Hedge is actually even more amazing. China secretly buying up massive amounts of gold, 10 times more than officially reported, according to Goldman Sachs. But that's old. That's from the end of last year. And then Zero Hedge reposted that and said, not so secret anymore. And that's true. This is, what we've seen is this tremendous increase in price that corresponds with this chart. We've seen a price increase that where we have these bull markets where it isn't the West that's doing the buying. And even people in our sector are going, what is driving this? Well, there it is.
The current trajectory of global markets reflects a more profound truth. Confidence in the monetary system is eroding from within. As debt mounts and policy responses grow more extreme, investors are beginning to recognize that traditional safeguards no longer provide absolute protection. Every new cycle of intervention chips away at the credibility of central banks and accelerates the move toward hard assets. That shift is not simply about hedging, it is about survival in a system where currency loses purchasing power by design. History has shown that monetary transitions come suddenly. For years, the cracks may appear manageable, but when sentiment shifts, it often does so at lightning speed. What feels stable today can unravel tomorrow, leaving those unprepared scrambling to adjust. The combination of global participation, easy access to alternatives, and the sheer scale of liquidity ensures that when the tide turns, it will not be gradual. The path forward requires clarity and discipline. Preserving wealth in such an environment is not just about reacting to headlines, but understanding the larger forces at play. Those who recognize the patterns of history stand the best chance of navigating what's coming. If you found this analysis valuable, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps bring these critical discussions to more people who need to hear them.